Pallavi is joining us now to talk about the FY25 advanced GDP estimates that have just come in. FY25 GDP is seen at 6.4% versus 8.24% in FY25. Pallavi, over to you.
That's right. GDP is estimated to grow by 6.4% for the ongoing fiscal year. This is actually the lowest in 4 years. The last time we saw a lower print than the one expected this time around was actually during FY21 when the Indian economy saw the impact of COVID. So this is 6.4%. It's not entirely a surprise given that we did see a bit of a shocker on the Q2 GDP front as well. It was a 7-quarter low and significantly lower than what was even being estimated. That did result in a lot of economists as well as the central bank pulling down estimates for the full year. So we are looking at a GDP growth of 6.4% for the ongoing fiscal. GVA is also estimated to grow at 6.4%. Now, the reason the first advance estimates are important is because it sort of helps the government set the base for the figures that they project for the budget. And what's important there is the nominal GDP. That is estimated to grow by 9.7%, and that's compared to 9.6% that we saw in the last fiscal. With that, let's quickly go on to Gaura Sen Gupta, economist at IDFC First Bank, to share her quick thoughts on what she's making of these figures. Gaura.
Hi, Pallavi. Thank you for having me.
Thank you so much for taking time out for us. So, to begin with, the figures seem broadly in line with expectations. Is that correct?
The real GDP, yes, it was in line at 6.4. We were at a 6.3. So it does indicate some pickup in momentum. So the first half GDP growth is around 6%. So some improvement, maybe roughly around 6.6 or 6.8% in the second half. So which broadly, I think it's very realistic in terms of real. What I would say is a little bit of a disappointment is the nominal GDP growth figure at a 9.7. So that's slightly lower than what the union budget was penciling in. So that has some implications for the fiscal deficit ratio. So if you plug in the nominal GDP numbers, it would shift the fiscal deficit ratio by around 0.1% higher.
Okay, all right. So, right, please continue. Sorry.
No, that's it. Broadly, in line with estimates, the real GDP, I think, was very realistic. The nominal was a bit of a disappointment. We are tracking slightly higher. So our nominal GDP growth rate is tracking at around 10.5, 10.3% because the deflator growth has been better. So even with a more subdued 6.4 real GDP growth, because your deflator growth is better this year, nominal GDP can be better than the 10.7 that they have done in the advance estimate. It can be closer to around 10.5, 10.3.
Okay, all right. I do want to understand, though, you did say that nominal GDP, as per your expectations, is expected to be a tad better than what's being projected by the CSO currently. But overall, given that growth appears to, like the 6%, the estimation is on the back of a better second half of the fiscal year, largely on the back of a pickup in government capex or the festive season spending, or be it, the other factors, the agricultural output, the Rabi harvest being better than expected. I do want to understand at this point, are there risks towards the upside or the downside on the overall GDP growth figures?
I would say they're to the downside because the high frequency, at least in Q3, FY25, is still not picking up. For example, we are seeing some signs of rural consumption picking up. You've got better fuel consumption. Rural wage growth has picked up marginally. But then at the same time, you're seeing certain segments of weakness. For example, two-wheeler sales growth has slowed down. You look at NREGA, the demand for employment under NREGA has picked up as the Kharif sowing has ended. Again, when employment demand under NREGA picks up, it basically indicates not a very strong rural job market. So on the urban side, we've seen a sustained weakness. Even if you look at company commentary, there is a sustained moderation in urban consumption, basically reflecting the fact that as listed company performance, the profit growth declined in the first half of FY25. urban wage growth also slowed, and we are seeing an impact of it on consumption indicators. You look at FMCG sales, you look at passenger vehicle sales. The key support to growth was from especially to the capex cycle, was the government capital expenditure, especially the center as well as states last year in FY24. In FY25, we've had a little bit of an unplanned contraction of the fiscal impulse, with the central government capital expenditure in FY25, at least in November that we have the data. There's a decline in central government capital expenditure. There is also a decline at the state government level at capital expenditure. So that impulse or support that we were seeing to the capex cycle from the government side is also a bit lower. So I would say on the whole, the risks are to the downside.
Okay, all right. Gaurav, one last question, a two-part question actually before we can let you go. So first of all, you did touch upon the implications of today's estimates on what it means in terms of the fiscal deficit for, as a share of the GDP for this time around, for this fiscal. So firstly on that, are we broadly still expected to be on target, given that the government had already set a fairly aggressive target for itself? And also, in terms of the industry-wise break up. Any surprises there? So we are looking at a fairly tepid manufacturing growth of about 5.3%. That's compared to a figure that's closer to almost 10% in the last fiscal. Again, given Q2 figures, not entirely surprising maybe. Agriculture, of course, is expected to have gotten better from the last fiscal at 3.6%. In terms of the tertiary sector, we're looking at a growth of 7.2%, with trade, hotels, transport at 5.8% and financial, real estate and professional services at 7.3%. So all in all, is that broadly in line with expectations? And on the first one, what are we expecting in terms of fiscal deficit figures?
I'll start with fiscal. So the nominal GDP is a bit weaker than what even the union budget had penciled in level terms. So it does artificially push up the fiscal deficit ratio. But the good part for FY25 fiscal is that because capex till November, the central government capex on a fiscal year-to-date basis is tracking, I think, around 12% lower. And there is a very good chance that we will not reach the full year target of 11.1 trillion for capital expenditure at the center level. So there will be expenditure savings that will happen on the expenditure side, which will balance out any potential shortfall that we have on the disinvestment receipts front. While broadly the tax collections have been on the stronger side, particularly the income tax collection, and we got a very, very large RBI dividend of 2.1 trillion. So the revenue side is well on track. The expenditure side is tracking a bit softer. So there is actually the fiscal deficit in level terms is likely to be lower. As per our calculations, the FY25 fiscal deficit in level terms can be anywhere between 800 to 900 billion rupees lower than the target levels. So even though the denominator, the nominal GDP was a bit lesser than expectations, there is no risk that the government will not achieve the 4.9% target. Actually, it's going to outperform, and the deficit is likely to be lower than the 4.9% target. And regarding the sectoral breakdown of the advanced GDP, very realistic. Manufacturing sector growth, the profit growth of companies has been on the softer side. It's actually reflecting the fact that sales growth has moderated. It's not just lesser support from the decline in input costs that we had in FY24, but also on the demand side, manufacturing firms are seeing a slowdown in sales growth. Is also getting matched with the high frequency, which is not looking so robust, especially for the urban consumption side. The services side of the economy is doing relatively better. Again, you see this in the listed company performance, where the services side of the economy is doing better. Trade, hotels, transportation, real estate has been one of the key supports to the capex cycle. So it's not just the government, but it's also the pickup in real estate post-COVID, which has helped the capex cycle. So that whole real estate, financial services segment, on the whole, at least for the real GDP, even the breakdown is very realistic, and the overall number is also realistic. But the risks, given the fact that high frequency, at least in Q3, which is supposed to be our festive season, is not really as It's not picked up as much as we would have hoped. There are some downside risks, but I would say very limited. On the whole, very realistic numbers. Even the internals are pretty realistic.
All right, Gaura, thank you so much for taking time out to speak to us and, taking a quick snapshot view of today's figures. GDP likely to grow at 6.4% for the ongoing fiscal. That will mean that India's economy will grow at the slowest pace in 4 years ever since the pandemic. Nominal GDP estimated to grow by 9.7%. And what these figures are likely indicating at is that fiscal deficit is likely to be on target or maybe a tad below the government's target. Well, we'll continue to bring more analysis on today's figures. Do stay tuned.